Welcome to the What to Watch video update. This is a video that I do once a week. It's the last video each week that I do. And I go through and I look at those areas of the market that are looking positive right now, and then those areas that are looking negative, and then the areas that I'm just keeping an eye on for the time being. Now, with most everything, there's a positive side and a negative side to most every chart. So, yeah, some of these charts could be considered negative that are on the positive side and vice versa. And I'll try to point that out, different things that I'm seeing. It's just to give us some perspective as to what's happening as the market's going through quite a difficult time and is still at an inflection point. We could bounce up out of this and start to really show an improvement. And there are some charts that we can look at that may suggest that. There are other charts that we look at that go, we might be in for some more trouble ahead. So that's what we do. We weigh this back and forth. And you can't just do this with one or two charts, one or two indicators. It takes, in my opinion, a macro look at what's going on with the stock market, getting that big picture and then whittling it down to, okay, now how can that be applied to the S&P 500 and different strategies that we implement? The question that we're asking this week, are more S&P 500 declines coming? This is being prepared for Monday, March 10th. The first thing we look at are those positive things. Now, in spite of the S&P going down, which you can see up here on the chart, we've been holding up fairly well with the advanced decline line. That's the positive side. Both based on price, we've been seeing a little bit of a deterioration here based on volume, but both of these are above these advancing moving averages. What might explain this is that we're not seeing money coming out of the market, which would send both of these going down. We're seeing money going from one place of the market into another place of the market. From a more offensive area where the market's getting ready to go higher, that's growth, to a more defensive area where the market's getting ready to go down, and we're seeing that shift. On up days, we see a little bit of a shift going back to growth. But what we've been seeing in the bigger picture right now is more of a shift going over to value. But for right now, though, the advanced decline lines are actually holding together quite well. Another evidence of that is shown by the 10-day advancers minus decliners. Now, we haven't really shown any conviction right now, but if we have a down day or two, we tend to drop below this zero level. If we have an up day, we're a little bit above it. But we're not really screaming up or screaming down currently, but this is hanging together for the time being. Another one of our smart money indicators, accumulation distribution, and this takes not only price but volume into account. It's looking positive. It's still hanging out above its moving average, and we bounced up in Friday's session. Even with the declines that we've been seeing, it's been coming down, but it has not fallen below this moving average. Now, there's nothing necessarily magic about the red line. I put the 20 period moving average on here, but it's served as a pretty good guide. And I've used this indicator for many years now. And when we drop below the red line, we're considered more negative. When we stay above the red line, we're considered more positive. So for right now, this indicator is holding up. Our other smart money indicators are not necessarily holding up right now, and I'll show those later. One of those that's also still looking positive, though, is another smart money indicator called the Chaikin oscillator. We saw enough of an upward move in Friday's session to go back above the midpoint, and we're above this moving average that I have plotted here. So this is actually looking positive. Another thing that for right now, you could take it as positive. After Thursday, this would have been negative. These are the stocks in the S&P 500 above their 200 period moving average. That's the long-term line in the sand to differentiate between positive and negative. We were coming down and actually dropping below 50. That means that under 50% of the stocks in the S&P were falling under their 200-day moving average. Well, in Friday's session, we bounced back up. And we've been above this, even as the market's been coming down. But I see this as positive for the time being because we're above 50. Now, this will quickly go over to negative if we drop below 50. This is the same basic idea, but just represented in a little different way. The percent of stocks above their 200-day moving average. This is set up like an oscillator where we look for extreme positive or negative readings. Not getting that right now. What we're doing is playing right around with this 50% level. We did drop a little bit below it after Thursday, but we came back above it after Friday. Another way to measure this is the distance from the 200 period simple moving average. And you can see by looking at the chart, we came down here. We actually dropped below it in Friday's session, but we were able to close back above it. That's the most important part, is where is the close? We might go all the way down here, but if we close back above it, it's still seeing as that support level holding. But we're really close right now. We're not very far away from that 200-day moving average, just 0.65%. So the market is at this tipping point. Now, for me personally, there's two aspects that I check off to see if we're positive or negative. If this blue line, which is a 50 period moving average, is above the red line, that's positive. That means the 50 period moving average is above the 200-day moving average, which is implemented in a very simple moving average crossover type system. If this blue line comes down and actually crosses below the red line, that's when we switch to longer term negative. That's one criteria. The other criteria is, are we above or below the 200-day moving average itself? Right now, we still are, and the blue line is above the red line. That's why I'm still defining the long-term trend as positive, but we're keeping an eye on this. Another thing that was kind of interesting, and if you've seen any of these videos or seen this chart that I showed before, it looks a little different now. These are anchored moving averages, which are different than regular moving averages because they try to project forward based on a high or a low. Well, since we've been going up, these are projected from former lows. And we've been breaking through some of the shorter term lows recently as we've been seeing some weakness. Now, how I used to display this chart is I would just use a line chart here, just meaning the closing value. I switched this over to an open, high, low, close bar chart here. And because I was really watching this on Friday. Now, this light blue area, it's like, okay, why is that important? If you remember back to about a year ago, we were really going up in 2024, and then we got overbought. Things were getting a little too optimistic, and then we pulled back. Not real significantly, but enough for people to start feeling pain. Then we finally bottomed and even almost tested that a time or two before really going up. This anchored moving average is going from that low. And this level held in Friday's session. We started to fall a little bit below it, but we closed back above it. And we're actually trying to get back to this other orange line here, which is another more intermediate term low. This was just a higher low as we were going up. I see this one as a little bit more significant. I remember what was going on at that time. People were freaking out. And oh my gosh, we're really turning and going down. Well, no, we were able to recover. So as long as this blue line is still holding up for the time being, and if we can go back and capture some of these other lines, naturally that would be more positive. Now, you could easily put this on the negative side. I have a number of different indexes here that show the advanced decline line, and I call it the advanced decline line studies. The reason why this is positive is because of the S&P 500, which is the real benchmark of the US stock market. We're still above this moving average here, where we're seeing below moving average action with the NYSE common stock, the mid caps, and the small caps, even though they bounced up a bit in Friday's session. But you could say this is negative because most of the indexes are negative, but because the S&P 500 is the real hub, that's why I'm keeping it on the positive side. Now, this could be positive, it could be negative, it could be nothing. This is an indicator called the mass index, and it tries to generate a signal that suggests that we might reverse. But there are three criteria that need to be met for this to actually trigger. And we've met two out of the three right now. The first trigger is we go above the red dashed line. Trigger number two is when we go above the blue line. Trigger number three is when we come back down and cross below the red dashed line again. Now, what was happening to make this mass index really come up? We were going down. So if we do get a signal, now the longer we go, once the signal is generated and nothing seems to happen, the more irrelevant this becomes. So it's kind of a short-term signal here. But since we were going down to trigger this, if we do get a signal, it would suggest that we might see a reversal to the upside. But we have no confirmation of that yet. We do have support levels that are holding right now, but all of our momentum indicators, our moving average indicators, they're all negative. We're just keeping an eye on this for right now. And because we've been going down, which may signal a bottom and then coming up out of that, that's why I have this on the positive side. The same thing is true with this, and we don't see a lot of these triggered together, this mass index and the praying bottom fisher at the same time. It could be getting ready that right about at the same time they will trigger a buy signal. And that's pretty much what the name says here. It's a bottom fisher. It tries to figure out when are we at a bottom, and then a signal will actually be generated when the black line crosses above the red line. So this is positive because we've been coming down. Now this is not very good at picking tops. That's why it's called a bottom fisher. It's pretty good at it's okay at picking bottoms. But remember, there's a cliche in the stock market. He who picks bottoms ends up with stinky fingers. So sometimes we've had some really nice, juicy signals with this thing. Other times we've had a nice signal and it really didn't lead to much of anything at all. All right, now longer term with the weekly chart, yeah, we've been getting hit with the S&P, but when you look at this trend line going back to the 1987 crash, even with the pullbacks that we're seeing, we're still well above that line. We're still holding up when we look at the QQQs, the small caps. And it's not that the Qs, which is the NASDAQ 100, are doing all that great. It's that the small caps are just doing terrible. But that's helping this overall ratio stay above this blue line, which is keeping things more positive. And also with the NASDAQ 100 to Dow. Now, the NASDAQ 100's been under pressure lately, and the Dow's been actually holding up better. If you watch the deep dive video that I do, I rate all of the 6 indexes that I follow on a scale of 0 to 100, and the Dow for the second week now has come in first place. And it's not that the Dow is doing all that great. It's just holding up better. Where we have the S&P 500 in second place. Why? Well, because there are blue chip stocks in the Dow. There are value stocks in both the Dow and the S&P, which, as you saw from the advanced decline line studies, the S&P is holding up a little bit better. The Dow's also been holding up better too, because they're considered to be the best of the best stocks. Well, we're coming down a little bit with this ratio, but we're still above this red line. So it's still holding up, which is positive for growth. Now we look at the negative side. Notice there wasn't very many things on the positive side, but there will be some positive things here that I'll point out, even though they're on the negative side. Now, because we had a down week, I'm treating this as negative. And we were just really having trouble. We started off on Monday, and then we saw late day selling. Then we saw some late day buying coming in on Tuesday and Wednesday. And that's when we were seeing a little bit of an improvement with our growth to value ratios. But it didn't carry over into Thursday. And then it looked like, oh, well, we're going to really go down here in Friday. But we're dealing with that 200-day moving average. That's right about where we set the low. We actually dropped a little bit below that. And then later in the day, we saw some buying coming in. Now, that could have been a technical bounce because a lot of our short-term indicators are extreme negative, and we were still at the point where longer-term support was holding. We'll see if that carries through into the upcoming week. If we break below this support, yeah, that's going to make things look a lot more negative. Here's a daily chart showing how we're dealing with the 200-day moving average currently. But it's negative because we're going down. And that's why it's like, okay, I could have put this on the positive side that we're still above the support level. Well, what happened to make us come down here? We fell, and that's why it's negative. Now, looking at the condition of our trend, this is the intermediate term trend, and that's the one that I focus on the most. We're negative. We're going up with the ADX. That's the actual indicator on this chart. I plot a moving average on here to give it some context, whether it's going up or whether it's going down. And it's going up. That means a strengthening trend. There's another static level at 20, which is if we're above 20, that means that we are trending. If we're below 20, that means we're not trending. Well, we are trending and we're above 20, and the red line is above the green line, so we're negative. Now, one positive thing that you might be able to read into this is as we've been coming down with the S&P, we've seen this red line coming down too. That's selling. So it's like we're seeing a little bit of a positive divergence here. We've been coming down with the S&P, and this is not a really healthy looking chart pattern either. As we've been coming down, we're setting a series of lower highs and lower lows here. But the red line, even though it's on top and we're negative, it's actually been coming down as the S&P's been coming down. You would expect just the opposite to happen with this chart. Now we go back and we look at the short-term trend here, where we're also in a trending environment. It's also negative, also seeing a bit of a negative, should say positive divergence here as the line's been coming down as the S&P's been coming down. And then once a week, I also talk about it in the weekly video, but I talk about it here. This is the weekly trend. And we are negative now. The red line's going up, the green line's going down. And we are possibly at the point where we're just starting a new trend. We've turned back up with the ADX. It's picking up this red line going up. The ADX is turning up, but it hasn't quite crossed above its moving average yet. So if this continues to go up and the red line keeps going up, that could be longer term negative on a trending basis. Now, this is interesting too. This is sentiment. We use the fear and greed gauge put out by CNN Money, and I show it in every daily, or I talk about the numbers in every daily video. I usually only show charts here in this video and in a couple other videos. What's interesting about this is this measures how are people feeling. And when they're really positive about things, we're going up, and then we get to a 75 level, and that means maybe people are feeling too good about things. And then when we come down, when we drop to 25 or below or around that area, it's like, well, maybe folks are feeling too pessimistic. And so when people are really happy, we look at, okay, maybe it's time to sell. When people are really pessimistic, okay, maybe it's time to buy. But if you notice, when we do that lately, over the last couple of years, when sentiment has really been coming down, we hit a climactic type of point here, either a little bit above or right about at 25, and then we bounce up out of that. And we came down, we hit a point here, and then eventually bounced up out of that. It took a couple of tries, but our time down here was relatively short. Then we also came down, bounced up out of that. Notice how we're coming down here and just camping in this area right now. We're not seeing much of a washout yet. People are just pessimistic and staying pessimistic. So this it's negative on the side that we're getting a low reading. It's positive that we're getting an extreme negative reading, but I'm treating this as a little more negative right now because people are just remaining pessimistic here. We're seeing an overall mood shift in things. Okay, then the VIX is above 20 and it's been going up even though it came down in Friday's session. When it's above 20, that's negative for the market. This is another thing that we're keeping an eye on. This is the spread between risky bonds, which like are like junk bonds, and not as risky bonds like government bonds that have no risk attached to them. When we get a real high reading on this chart, that means there's no risk between the junk bonds and the more conservative bonds. When this starts coming down, that means fear is increasing. This is actually an inverted scale to match up with what the S&P is doing, and I've also inverted the VIX here. We're keeping an eye on this. This is dropping down. That means there's some fear coming into the market, and if this keeps falling, that's going to be more negative. Now, this is the bond market. I'm involved in the stock market, and that's what I talk about. That's why I have this near the sentiment charts. This is just what's being perceived as fear right now in the market. So we're seeing this picking up a little bit, and we'll just watch this. If it goes back up, that'll be more positive. If it keeps going down, that'll be more negative. We are seeing a shift recently where the blue line had been above the red line. That means on an intraday basis, growth is outperforming value. Now the red line's above the blue line. That means value is outperforming growth on an intraday basis, and that's more defensive for the market. And then it looked like we were getting a couple of nice days here, but when we look at an intraday growth to value ratio for the S&P, we've really been coming down. We did start to bounce back up. This was back Tuesday and Wednesday when we saw more buying going into the close. Well, we gave all that up on Thursday. We bounced back up a little bit after we declined on Friday. But overall, the bigger picture is that this has been going down and that's more negative, meaning the market is turning more defensive. And then we break it out looking at the small caps where they're not doing very well. We're still in an uptrend here with this overall ratio, but we're coming down and actually dropping below the 200-day moving average as small caps continue to fall off a cliff. Mid caps also coming down and dropping below their 200-day moving average as that index has been quite weak. And we're dropping way below the 200-day moving average with our S&P growth to value. Now it's still in an uptrend, but this is what's producing a lot of the unsettledness with the market right now. Growth, to put this another way, value is outperforming growth. That means the market's buying toilet paper and toothpaste, healthcare, the things that you have to have, if the economy is getting ready to really slow down and possibly go into a recession. But longer term, we're still in an uptrend here. So we've seen damage done here before, and we were able to get that back. What the market is trying to figure out right now, are we going to get that back and actually bounce up out of this, or are we going to shift and turn more negative? This is also suggesting that growth is underperforming value here. We're coming down out of the rainbow. A couple of days, we started to come back up. That was giving us a little bit of hope. Well, now it's going back down. And we look at our growth to value ratios. The Q's to S&P below a declining moving average. Discretionary to S&P below a declining moving average. Large cap growth to large cap value below a declining moving average. So we're going down with the large caps, mid caps, and we came back up to the moving average with the small caps, but we're still dealing with a declining moving average here. I pointed this out a week ago. We were still above this red line, which is the 200-day moving average for the large cap growth ETF. Now we're coming down below it. We actually lost the support. And we could get it back. Markets have a tendency to overshoot, but this is still at a rather interesting tipping point currently. And we're seeing a real breakdown of discretionary to staples. Even though the trend is up, we've really been coming down close to the 200-day moving average. And this is an equal weight version of the discretionary sector. If you look at a regular sector or regular chart of the discretionary sector, it's going down with a lot more force. That's because Tesla's been getting hammered. Well, this is an equal weight. So Tesla's in there, but it's not, it doesn't count for as much of the particular sector. And this had been holding up fairly well around its 50-day moving average, but lately it's been coming down. So we're seeing more broad weakness here, coming down to its 200-day moving average. At the same time, we're seeing a real advance here of staples. That's a defensive area. And that's why we're seeing this ratio really coming down. Now, back to last summer, up until about the end of 2024, the discretionary sector was the best performing sector for the market. Now it's really dragging on the market overall. And this is kind of a growth versus value type of area. And we're seeing this coming down, the risk on versus risk off. When this is going up, folks are buying the big name stocks and buying the large cap stocks, and the market's usually going up. When this is coming down the way it is now, it ticked up a little bit on Friday. That means they're getting more defensive. They're getting into the equal weight part of the S&P 500 instead of the high beta. This is Google, Apple, Nvidia, Microsoft, the big name stocks. Those are called high beta, which tend to outperform the market when we're going up, but they go down faster when we're going down. They underperform quicker. So this ratio coming down is more negative. And we're turning more negative here with the new highs, new lows. Now, you notice the last couple of days, we haven't seen a whole lot generated. There were a massive amount of new highs this past week, earlier in the week, but we also saw a whole lot of new lows. But the real drop off in new highs and a bit of an expansion in the new lows is turning our 5-day chart down, but we're actually trying to stabilize here with our 10-day chart. And this is smart money indicator number 3, where it's still negative. The histogram is positive, but we're going down and the red line's going down. That's why this one is negative. The vortex, another primary indicator, we have the red line going up as the green line's going down. That's negative. We're below the Ichimoku cloud, and we have the blue line going below the red line, and the green line, for the most part, has been coming down. That's negative. And we look at a 5-period moving average of the highs and lows for those stocks in the Amex, NASDAQ, and NYSE. We're below zero and declining. Now we look at the condition of our intermediate term trend. I'm not really focused on the short term trend right now. We're trying to battle a bigger picture right now, but we're still going down here and we're below both of these lines. That just means the intermediate term trend is still deteriorating. Oh, I guess I do have the 20 period. This is short term. I should have had this chart first, but we're still going down here in the short term as well, based on 20 periods. Then we look at all the moving averages. We're below the 20 and 50s and 100s. Now we're down here seeing, okay, are the 200-day moving averages going to hold? But we're getting kind of far away from that 20 period moving average. This is the boom indicator, and it measures the distance from price to the 20 period moving average. And when price is below, we get a negative reading. And we're getting kind of far away. We had been far away from the 50 period moving average, but we worked some of that off. And we're coming down and just about at the zero level here between positive and negative when we measure the distance between price and the 200-day moving average. We improved on Friday, but the McClellan oscillator for the S&P is still below zero. Now you notice there's a lot of choppy stuff going on here. We have an up day, we're slightly positive. We have a down day, we're slightly negative. So there's not a lot of conviction going on right now as the market has been going down. But since we're below zero, that's negative. And when that's below zero, we're declining based on price, and we're actually dropping below the midpoint here with the summation index based on volume. So both of these charts are negative. And we improved on Friday, but we're still below zero with the NYSE McClellan oscillator. That's a broader market measure. So we're declining with the summation index based on price and volume. And we're turning back down with the Swindle Trading Oscillator based on price and volume. We're below zero with both. That's negative. And we're negative with the daily chart of the parabolic SAR since the dots are on top. And after this week, we now have a dot on top with the weekly chart. So longer term, we're turning more negative. Momentum is negative across the board in the short, intermediate, and long term. For the S&P, we're declining with the bullish percent index. We ticked up a little bit in Friday's session, but we're still showing overall weakness here. We're declining and actually trying to flatten out here with the NYSE bullish percent index, but it's still negative. We ticked back up, but we're below 50 here with the NASDAQ 100 bullish percent index. And we had some new O's drawn in this past week, and we're working off of a double bottom breakdown right here. As when there's more O's in that get drawn in here, that means we're declining. And again, why is this not on the positive side? We're above the 61.8% retracement level because we came down to hit it in the first place. So this is another support level that's close to where we're at right now, and it's lining up kind of close with the 200-day moving average. We did fall down below it, but we were able to close back above it in Friday's session. Can we bounce up out of this and keep going, or are we going to lose this support and keep falling? This, in my opinion, is a longer term reason why we're seeing what we're seeing. Back in December, we hit the upper end of this long term trend channel, and that's where we really started to slow down as far as the market was concerned. And now we're actually starting to decline. We'll have to see if as this line keeps going up. Maybe we can turn and go back up and actually set a new all time high, but we're not even close to that yet. We'll have to see if this still keeps being influential with the market. And then we're seeing this ratio coming down. That means that the S&P 500 weighted index has been underperforming the equal weight version of the S&P, and that means the index is getting more defensive. You notice here in 2023, this was really going up. That means that the big stocks were really driving the index higher. When this is really coming down, this was in 2022 when the market was more defensive. Now, nothing has really been all that decided yet. We're just keeping an eye on this to see, are we going to break and go back up, or are we going to continue to fall down? The NASDAQ is under its 200-day moving average. That's negative, and the NASDAQ 100 is just about at, but slightly below its 200-day moving average. The Q's coming right back up to its 200-day moving average. So there's a little bit of hope here. But on the negative side, we're seeing the 20-period moving average dropping below the 50. And the fact that we even came down to the 200 should be taken as negative. But maybe we can bounce up out of that. Here's a weekly chart showing 3 red candles for the last 3 weeks. The Wilshire, again, why are we negative? We fell down below the 200-day moving average, but we're still slightly above it after Friday. This is a broad market measure. Another broad market measure, the total US stock ETF, has us just about at the 200-day moving average. Financial sector. Now, this has been a stronger area going back to 2024, and it's been holding up, but we're seeing a lot of weakness right now. It's dropping below its 50-day moving average. And when interest rates are going up, when the economy starts to have some potential problems, I keep a close eye on the financial sector because this is what started to fall apart when we went into the great financial crisis. But I mean, it's still positive right now. We could get this back. We've fallen below this before, but we're able to bounce back up. But this is also kind of negative right now. Inside of the financial sector is the bank ETF. And I was getting a little concerned when we were falling below its 50-day moving average. Now we're dealing with the 200-day moving average. But so far, this support level is holding. And then here, these are regional banks. These are smaller banks. This is like Silicon Valley Bank, Republic Bank, New York Community Bank. We're coming down to the 200-day moving average, but so far that point is holding. But now, when we do a ratio of the regional bank ETF that we just looked at with the financial sector, the regional banks, the smaller banks, are really starting to underperform enough to see a death cross here with this ratio. That's negative. The FANG index came down to its 200-day moving average, but so far that level is holding. These are the big stocks. And then we look at technology starting to fall below the rainbow here, looking more negative. Semiconductors, which are a huge part of tech, this had actually been positive, but we've been chopping sideways. Now we're starting to break lower, and we're getting really close to a death cross here with this trend. And we're falling below the rainbow. This is that same ETF, just showing different studies on here. And then we look at the semi to tech ratio, not really showing much conviction either way. You could say it's positive that the semis aren't really going down, but you could say it's negative because the semis aren't really going up because both of these areas have been under a lot of pressure in 2025 so far. And then here's the Dow Jones Semiconductor Index itself, falling below its 200-day moving average. And the longer we stay below this, the more this could actually end up turning negative as far as a trend. And then this is the SOX index, which is in a downtrend. And we started to see this back in late 2024. Now we're starting to drop down a little bit more here, which is negative. Robotics AI ETF. AI, it's where it's at, man. Well, we're dropping below the rainbow here. And then here's another AI and tech ETF, which is holding up better and has been a little bit stronger. We're actually dealing with the 200-day moving average. And so far, we're still above that. We bounced up off of it on Friday. So this is giving us a little bit of hope. But I wanted to keep all these charts together because they've been showing general weakness. Then we look at a ratio between stocks and bonds. And when we're up in this area and the lines are going up, that means the market is anticipating a soft landing, meaning that we will not go into a recession. Well, that's in doubt right now as we're coming down through the rainbow, and we'll keep watching this. If we start to fall below the rainbow and these lines roll over more and actually start to go down, then it might mean the market is anticipating that we're going to go into a recession or what they call a hard landing. This is that same thing, but just showing bonds and how they've been underperforming, but now they've been really coming back lately. Then we look at the S&P 1500, another broad market measure, and compare it with short-term bonds, 1 to 3 year. We're coming down to the bottom end of the rainbow. Another broad market measure, we look at 3 to 7 year bonds at the bottom end of the rainbow. The tech sector to 3 to 7 year bonds falling below the rainbow. The QQQs, the 3 to 7 year bonds, kind of right down here at the bottom end of the rainbow right now. And home construction, it did bounce up a little bit, but this was a stronger area in 2024. It's just really seeing some weakness now. That's negative too. And when we see the staples to tech ratio going up, that means staples are outperforming tech. That means the market's getting more defensive. And that's what we're seeing right now. And when we see staples outperforming the S&P, that also means the S&P is getting more defensive. Long term, this has been on the positive side for quite a while. This is a weekly chart of the NASDAQ 100. When we're above this red line, that's positive. Well, I have it on the negative side here because we're dropping below this long-term trend line. And then semiconductors to Dow, this continues to decline overall. This is growth versus value right here. And I have it on the negative side because the last couple of days interest rates have been going up, but if interest rates continue to go down, that's generally more positive for stocks. Then we have this thing called the Hindenburg Omen, and the perma bears love this thing. I use the criteria right here, and if you want to stop this and look through these are the three criteria that need to be met for a Hindenburg Omen, which is, the blimp that blew up. Whenever those happen, that can be quite negative. Now, this past week, we had an initial signal, a spike up here. That doesn't mean it's real. It doesn't mean it's confirmed. But the last time we saw a series of spikes was right at the end of 2021, going into 2022, before we really started to head down. We have until March 3rd, till March 31st, that's 20 trading days, to see another spike here. If we don't get one, then this one falls off the books. If we do get another spike, and then the more spikes we might get after that, that's going to suggest things are more negative. Then some things that I'm watching. Just keeping an eye on jobless claims here, and they actually declined, and we're still kind of going up a little bit here with the 4-week moving average. But when these decline, that means the employment situation is pretty strong. But we're going up with the continuing claims. Those folks that are getting laid off are staying laid off right now, and this is actually trending higher. And then just to give it some context, I have the initial claims in red, the continuing claims in blue, and then on Friday we had the unemployment rate updated to 4.1%. This I'm just watching from a percentage basis. When we set the all-time high not too long ago, how much have we declined on an intraday basis? And it's over 7% right now, getting close to 8%. If we actually go down to the 10% level, that's when we'll actually be in a correction. So this is what we're watching. Notice how we got really close to that 10% level when we declined last summer. And then when we got about to that level, this is when the smart money started to really come in. We saw a little bit of a pullback here, but it was just more of a pullback. Right now, this could be just a short-term decline, but if it starts to go over 10%, that's going to change the overall dynamics. Keeping an eye on cash to 3 to 7 year bonds, this has actually been coming down. And when this comes down, that means that uncertainty about inflation and interest rates are actually, the fears are decreasing. And so this is actually more positive when this comes down. Now, if it goes back up, that'll be more negative. And we're seeing a real drop off here. Tips, they adjust for inflation. When interest rates and inflation are going up, people get into tips. When they think that interest rates have topped out and they're going to start coming down, then they get into 3 to 7 year bonds. Well, we've been seeing this going back up, which means there's inflation fears that tips are outperforming 3 to 7 year bonds. But lately, this has really been dropping back down. And we're also seeing that when we look at tips to 7 to 10 year bonds, go a little bit further out. This has been coming down lately. Does this mean that inflation concerns are subsiding? We don't know that, but the market is thinking maybe they've overdone it as far as those fears. Now, this could turn and go back up at any time. We just have to go with what we're seeing right now. And then this is interesting too. The Eurozone. Germany's just been on a tear lately. And when we compare the Eurozone with 3 to 7 year bonds, you can see how European stocks have really been outperforming here. But if you look at it a little different way, this is the S&P 500 and the German DAX. Look at how the S&P has been underperforming stocks in Germany. Now, about the time folks start to catch on to this and say, oh, I'm taking my money out of the US and I'm throwing it into the German stock market, it'll be about the time this ends because folks are really bad at timing. But you can just see here how the German market has really been outperforming or the US market has been underperforming. Then this is interesting too. You notice how we've seen a real spike up with the German 10-year yield? They call it a Bund over there, B-U-N-D. Well, we had some things going on between US and Ukraine and Zelensky, and then he flew back over to Europe. Don't worry, Zelensky, maybe we'll help you out. Well, the bond market picked up on that and they said, okay, we might help out Ukraine, but you're going to pay a lot more for it. That's the interpretation that I'm getting from this because we've seen interest rates really going up right now. Now, this could come back down and they're not as high as they were before, but we just kind of watch this going on to say, okay, how's this going to impact things in the US stock market? We're keeping an eye on the 10 to the 3 month yield curve. It's right at zero right now. It came down and actually went inverted again. And as of Friday, we're back where both the 10-year yield and the 3 month yield are at the same rate. This signals that something's wrong in the economy. And then we're keeping an eye on the 10-year yield in Japan because this going up, that's what caused all the problems last summer. If this keeps going up, is that going to cause another problem? You can see the blue line here really going up here with the German 10-year rate. And we want to keep an eye on the dollar, which is still in an uptrend, but just getting hammered this past week as things are shifting with the whole, is the US going to help Ukraine? Is Europe going to help Ukraine? Are there going to be boots on the ground from Europe? The US has already promised we're not going to do that. The US has said maybe we'll get out of NATO. Yeah, well, that's kind of decreasing the value of the dollar right now. Thank you. I really hope you found this helpful. Have a really good weekend, and I will talk to you in the next video.